Now, what if I told you that 73% of business acquisitions fail to meet expectations, or that according to Harvard Business Review, the failure rate of mergers and acquisition ranges between 70 and 90%. Now, here's the truth. Most people buying businesses are making decisions based on incomplete information, surface level metrics, or worst of all, their gut feeling. But what if there was a systematic approach to evaluating businesses that could dramatically increase your chances of success? A formula that's so effective that's been used to identify hidden gems while avoiding costly mistakes. Now today, I'm sharing the exact 3-part evaluation formula that sophisticated acquirers use to assess any business opportunity, from small e-commerce brands to multinational corporations. Now this is the same framework that's helped my clients avoid millions in potential losses and identify opportunities that delivered extraordinary returns. Stay with me because this could be the most valuable 15 minutes of your business acquisition journey. Now welcome back to the channel. For those joining us for the first time, we focus on helping investors, entrepreneurs, and high-income professionals build wealth through strategic business acquisitions. Now today we're diving into something we've never fully revealed before, TrendHijacking's complete 3-part formula for evaluating any business opportunity. While this approach works across industries, we'll be sharing specific examples from e-commerce spaces where the opportunities for individual investors are particularly strong right now. As Warren Buffett once said, risk comes from not knowing what you're doing. Now this formula is designed to transform uncertainty into clarity, helping you make confident decisions backed by data and strategic insight. Let's get started. Part 1, financial sustainability. Now, the first part of our formula examines what I call financial sustainability. It's the bedrock of any successful acquisition. While most buyers obsess over revenue and profit figures, they often miss the deeper financial dynamics that determine whether a business will thrive or collapse under new ownership. Now, here are the 3 critical components of financial sustainability. Component 1, cash flow reliability. Cash is oxygen for businesses. Even profitable companies suffocate. According to a US bank study, 82% of businesses fail due to cash flow problems. Yet most acquisition evaluations focus on reporting profits rather than actual cash generating and timing. Here's what to analyze. Cash flow sessionality. Now, I identify patterns in monthly cash flow over at least 24 months. A business might be profitable annually, but experience severe cash crunches seasonally. For example, an e-commerce business we evaluated showing strong annual profits, but required significant inventory investment 5 months before their peak selling season. Now, the previous owner had a line of credit that wasn't transferring with the sale, but a detail that would have just created a $300,000 cash shortfall for the new owner. Now, customer payment terms versus supplier term. The gap between when you pay suppliers and when customers pay you creates either positive or negative cash flow pressure. One acquisition target had 45-day supplier terms, but offered 60-day terms to their largest customers, creating a constant working capital deficit that didn't appear in the annual financials. Non-operating cash flows. Separate one-time or non-business cash flows that may distort the picture. Now, a recent evaluation revealed a business where the owner had been recording personal Amazon purchases through the business account and then reimbursing the company, creating artificial cash flow volatility that disappeared once properly accounted for. As financial expert Robert Kiyosaki notes, it's not the profit that matters, it's the cash flow. Assessing cash flow reliability gives you insight to the true financial health of the business. Component 2, cost structure analysis. Understanding a business's cost structure reveals both vulnerabilities and opportunities that profit margins alone won't show you. Now, here's what to examine. Fixed versus variable cost ratios. Businesses with high fixed costs are less adaptable but potentially more scalable once break-even is reached. According to research from McKinsey, businesses with more than 70% variable costs tend to weather economic downturns better. And while those higher fixed costs often see more dramatic valuations increase during growth phases. Cost concentration risk. Now, identify in single cost centers that represent more than 25% of total expenses. One e-commerce business we evaluated had 68% of its costs tied to a single fulfillment partner who had announced a 40% rate increase scheduled to take effect 2 months after the proposed acquisition date, a detail the seller forgot to mention. Margin trend analysis. Look beyond current margins to understand the trajectory. According to data from a Bain & Company study, businesses with steadily increasing gross margins outperform those with stable margins by 3.5 times over 5 years, regardless of the starting margin level. Now, Peter Drucker wisely noted that if you can't measure it, you can't improve it. A thorough cost structure analysis gives you the measurements you need to identify post-acquisition improvement opportunities. Component number 3, financial adaptability. Now, this often overlooked component assesses how well the business can adapt to changing conditions. Now, here's what to evaluate. Break-even analysis. Calculate how much sales can drop before the business loses money. Resilient businesses typically have break-even points at least 35% below current sales values and levels. In one e-commerce brand we evaluated had a break-even at just 12% below the current revenue, revealing dangerous fragility apparent from their 22% margin. Now, pricing power. Determine if the business can raise prices without significant volume loss. Warren Buffett considers the single most important attribute when evaluating businesses, saying the single most important decision in evaluating a business is pricing power. If you got the power to raise prices without losing business to a competitor, you've got a very good business. Now, cost variability options. Identify which costs can be quickly reduced if needed. During economic downturns, businesses that can quickly reduce 30% of their costs survive at nearly 3 times the rate of those that cannot, according to Harvard Business School research. As Charlie Munger says, "All I want to know is where I'm going to die, so I'll never go there." Financial adaptability analysis helps you identify where a business might die under financial stress and whether you can prevent it. Part 2, strategic positioning. Now, the second part of our formula examines what I call strategic positioning, the business's competitive stance and market trajectory. While financial analysis tells you where a business is today, strategic positioning assessment reveals where it's likely to be tomorrow. Now, here are the 3 critical components of strategic positioning. Component number 1, market dynamics. Understanding the market environment is crucial for evaluating long-term variability and viability. Now, here's what to analyze. Market growth rate. Determine if the overall market is growing, stable, or declining. According to BCG, businesses acquired in growing markets, 5+% annual growth, outperform those in stagnant markets by 3.2 times over a 5-year period, even with identical initial financials. Now, disruption vulnerability assesses how vulnerable the business is to technological or market disruption. One e-commerce business I evaluated had 85% of revenue from products facing imminent competition from Amazon Basics, a competitive threat that hadn't yet impacted financials, but would dramatically change the business's prospects. Regulatory landscape. Identify current and potential regulatory issues that could impact operations. Now, a health supplement e-commerce brand I reviewed was using marketing claims that had recently triggered FDA warnings to competitors and a regulatory risk not disclosed by the seller that could have resulted in significant penalties under new ownership. As Jeff Bezos noted, in business, what's dangerous is not to evolve. Now, market dynamic analysis helps you predict how a business may need to evolve and whether it's positioned to do it successfully. Component 2, competitive advantage. Warren Buffett's concept of an economic moat, a business's ability to maintain competitive advantage, is essential to long-term success. Here's what to evaluate. Unique value proposition. Identify what truly differentiates the business from competitor. Now, according to research from the Cambridge Strategy Group, businesses with clearly articulated unique value propositions captured 8% market share over time than those competing primarily on price or even convenience. Switching costs. Determine how difficult it is for customers to switch to competitors. High switching costs create customer stickiness. One e-commerce business we evaluated had developed a proprietary sizing system that once customers learned it, created reluctance to shop elsewhere, a significant advantage not reflected in traditional financial metrics. Barrier to entry analysis. Assess how difficult it would be for new competitors to enter the market. Now, patents, specialized knowledge, exclusive supplier relationships, and high capital requirements can all protect the business from new competition. One acquisition target owned manufacturing equipment that required both substantial investment and now unavailable environmental permits, creating a nearly impenetrable barrier to new entrants. Now, the component that helps you determine if the business's advantage are truly sustainable. Component 3, growth potential. As Michael Porter wrote in Competitive Advantage, the fundamental basis of above average performance in the long run is sustainable competitive advantage. Even a perfectly positioned business today may represent a poor investment if it lacks growth pathways. Here's what to analyze. Addressable market expansion. Evaluate opportunities to reach new customer segments or geography. McKinsey research shows that businesses with clear paths to market expansion command 2.3 times higher acquisition multiples than those limited to their current market segments. Product line extension potential. Now, according to Harvard Business Review, businesses that successfully extend identify logical expansions of the current product or service mix. Product lines grow 27% faster than those that solely focus on existing offerings. One e-commerce brand we evaluated had customer data revealing 3 high-demand product categories their customers were currently purchasing elsewhere, representing immediate post-acquisition growth opportunities. Scalability assessment. Determine if the current business model can scale without proportional cost increases. Scalable businesses typically create value more quickly under new ownership. The Aegean direct-to-consumer brand we assessed and had developed custom inventory forecasting software that allowed them to operate with 40% less inventory than competitors while maintaining higher in-stock rates, a scalability advantage that would become increasingly valuable with growth. As Mark Anderson once said, "Software is eating the world. Business with technology enables scalability, often represented by the best acquisition opportunities in today's environment." Part 3, operational integrity. Now, the third part of our formula examines what I call operational integrity, the systems, processes, and people that make the business function. This is where the most acquisitions evaluations fall short, focusing on financial results without understanding the operational engine that produces them. Here are the 3 critical components of operational integrity. Component 1, process documentation. The difference between buying a business and buying a job often comes down to process documentation. Now, here's what to assess. Operational playbooks. Evaluate the quality and completeness of documented processes. According to the Exit Planning Institute, businesses with comprehensive operational documents sell for about 1.5 to 2 times higher multiples than those relying on undocumented knowledge. Automation level. Identify which processes are manual versus automated. One e-commerce business we evaluated was spending 20 plus hours weekly on manual inventory updates, a process that could be automated for a one-time $8,000 investment, immediately freeing up resources for growth initiatives. Bottleneck analysis. Determine operational constraints that limit growth. Now, the theory of constraints teaches us that any system is only as strong as its weakest link. One acquisition target that impressed growth but was constrained by manual order processing that created fulfillment delays during peak periods, a bottleneck that once identified could be eliminated with targeted investment. As Michael Gerber writes in the E-Myth, the system runs the business and the people run the system. Evaluating process documentation reveals whether you're buying a true system or merely the owner's personally daily effort. Now, component number 2, team assessment. Even with excellent documentation, the people executing processes determine success. Now, here's what to evaluate. Key person dependencies. Identify roles where knowledge or relationships are concentrated in a single individual. Now, according to the Business Enterprise Institute, businesses with significant key person dependencies sell for 30 to 50% less than those with distributed expertise. One e-commerce business I evaluated had 85% of supplier relationships managed exclusively by the owner with no team member introduction, creating a massive transition risk. Skills gap analysis. Determine what expertise is missing from the current team. Now, one acquisition target had strong operations, but lacked digital marketing expertise, leading customers' acquisition costs 40% above industry benchmarks, an opportunity for immediate improvement under new ownership. Cultural health indicators. Assess team stability, engagement, and alignment. Now, high employee turnover often indicates deeper operational problems. A business I evaluated had replaced their entire customer service team 3 times in 2 years, a red flag that revealed serious management issues not apparent in their financial statements. As Peter Drucker observed, culture eats strategy for breakfast. Now, team assessment helps you determine whether the business has the human capital to execute its strategy. Component 3, technology infrastructure. In today's business environment, technology infrastructure often determines both operational efficiency and future adaptability. Here's what to analyze. Tech stack evaluation. assess the quality, integration, and how modern the key systems are. According to Deloitte, businesses with well-integrated technology systems achieve 35% higher operational efficiency. One e-commerce business that we evaluated was using a patchwork of disconnected systems, acquiring and requiring an extensive manual data transfer, creating both inefficiency and error risk. Data asset quality. Determine what customer operational and market data business collects and how it's utilized. Now, in the digital economy, proprietary data can be more valuable than an actual physical asset. An acquisition target we reviewed had 5 years of detailed customer purchase data, and they weren't leveraging it for marketing, representing an immediate revenue potential under new ownership. Technical debt assessment. Identify delayed technology investments that will require future attention. Now, one e-commerce business was operating on an outdated platform scheduled for end-of-life support within 6 months of the proposed acquisition. A looming expense and operational disruption not factored into the asking price. As Mark Benioff once said, founder of Salesforce, he noted that only constant in the technology industry is change. Now, technology infrastructure assessment helps you determine whether the business is positioned to adapt to inevitable changes. Bringing it all together, the evaluation matrix. Now that we've covered all 9 components across our 3-part formula, let's discuss how to bring this together into a practical evaluation framework. I use what I call the acquisition opportunity matrix, a simple scoring system that helps quantify what would otherwise be subjective judgments. Here's how it works. Rate each of the 9 components on a scale of 1 to 5. 1 being significant problems requiring immediate attention, 3 is industry average performance, and 5 being exceptional performance creating competitive advantage. Now, weigh each of these components based on the importance to the specific acquisition. Critical components have 3 times weight, important components have 2 times weight, and standard components of 1 times weight. Multiply the ratings by weights, and of course, sum the total. This creates a score between 9 and 135. With successful acquisitions typically scoring above 90. The beauty of this approach is that it forces you to evaluate businesses systematically rather than emotionally, which is crucial given that research from Inseed shows that 78% of acquirers overestimate their ability to objectively evaluate businesses they're personally interested in. The 3-part formula we've covered today, analyzing financial sustainability, strategic positioning, and operational integrity, provides a comprehensive framework for evaluating any business acquisition opportunity. By systematically examining each of the 9 components we've discussed, you've dramatically increased your chances of making successful acquisitions while avoiding costly mistakes. This exact formula has helped us evaluate hundreds of e-commerce businesses at TrendHijacking, now many of which are currently listed on our platform. We help serial entrepreneurs and busy professionals buy, build, scale, and exit e-commerce brands for maximum value. The best part is, everything is managed for you. At TrendHijacking, we handle the entire process from acquisition to exit. Our team applies this 3-part formula to identify high potential e-commerce businesses, then manage all the aspects of operation and growth, allowing you to build wealth through business ownership without sacrificing your time or taking on operational headaches. If you're interested in exploring pre-vetted e-commerce acquisition opportunities that have already been evaluated using this formula, visit trendhijacking.com to see our current listings, and these are fully managed for you businesses. Thank you for watching. If you found this valuable, please hit the like button and subscribe for more content on business acquisition strategies. Until next time, invest wisely.